that's what
Exactly.
our Radar Quant Fund trades. Speaking of the Radar Quant Fund, we just released the February performance. Uh, the Radar Quant Fund has made 13% in February alone, and with 4.59% alpha against the SPX.
Year to
So,
date. That's year to date. Yeah.
yes, that's year to date. January was not a full month. That was about half a month as well. So we kind of gave SPX a little bit of a lead. But we fully expect to absolutely crush the SPX's performance this year and every year going forward. The Radar Quant Fund does have a 47% compounded annual growth rate since 2016. And
Yeah.
we are expecting that growth rate to maintain for the next few years at least. There is a Bitcoin component, so obviously, as Bitcoin gets older, it's not going to have the same crazy moves. So that 47% CAGR will eventually start teetering down, but it's going to stay 47% for a while, I think.
Yeah. So I want to speak a little bit about the Kager, right? I think that there's a good possibility we have the ability to provide some really excessive alpha over the next coming years here, and that's why we're doing what we're doing at Market Radar. The only thing is you have to be mindful of how this works, right? There will not always be positive net alpha every month. Maybe we'll underperform a year here, a year there. But that's why having a powerful Kager, at least what we've seen historically, is so powerful in a model like this because we can underperform the market by 5%. We can have negative net alpha of 5 to 10% one year and absolutely blow it out of the water the next year. So I think you have to look at this like more than just a month, a mark to month performance. You have to look at it more on like a rolling basis. Like how can we, like once we roll through 2024, I think a lot of you will have a bit of a more based understanding of what's going on with the model and how to expect it and how it moves. That even when it underperforms in some areas, it can pick it up in other ways in other areas, and it's more dynamic than just saying like, okay, it there's a spread, and once it spreads dead, um, the model's dead because we've seen historically the alpha is actually in a degree cyclical, right? It'll come up and it'll blow up and then it'll kind of roll off a little bit where S&P likes to play catch up against RQF, and then RQF will accelerate again and so forth, like kind of like waves. And that's why we say we want to ride the waves. We don't want to sit there in time, and day trading, not for that's for the normies. We don't day trade, okay? That's simp behavior. We sit here, we execute on a much bigger time frame, and we try and ride as many of the waves as we can. Because at the end of the day trading is not where the edge is unless you're making the market. And I can guarantee that if you're listening to this podcast, you're not making the market. The market might be making you off the commissions and off the options fees that you're doing on the zero DTs or whatever option strategy you're doing, but you are not making the market. And therefore, trading on such a tight time frame is probably not a good idea. But you manage your own risk and do as you wish. But
Another pretty solid week under the belt. Failed to
yeah,
break below mid vamp once again. It's feeling very
yeah,
resilient.
no, I 100%. And like, I think a lot of people are just shocked, to say the least, on what's going on here in the market.
Yeah, like
Um,
a lot of people still can't believe that growth is in fact still strong, even though interest rates are at 5%.
yeah, we'll talk a little bit about that in terms of strong growth and a growing, ever so growing, overly restrictive Fed. Some people they can't put those two terms together: strong growth and overly restrictive Fed. Especially equity prices at all-time highs. That blows minds. Absolutely tears them out of their seat when they see that someone says that that the Fed is restrictive and the S&P 500 is hitting new all-time highs. But we'll talk a little bit about that later in the episode. But let's talk about what is going on right now in the S&P 500. So far, obviously this last week was just basing, and now we're going back up. We're printing new all-time highs on Friday, and as we've said, as long as we're in a number one bullish trend, a supportive risk environment, and third above mid vamp, this being this where this one mark is, right? As long as we're above number one, the base case should be new all time highs. Now, we said this a few podcasts ago, but I'd like to reiterate it that regardless of the macroeconomic situation, unless you're living in a very, I should say, short-sighted country that has little upside, your base case should always be bullish. And even then, matter of fact, remove that last statement. Your base case should just always be bullish. Now, you have to take into account the situation where you are, the data that's coming in, and more importantly, the sentiment that's going around. Put all that together and then have the culmination of all these things disprove that bullish thesis case. Your base case should never be the market's going to go lower or the risks are too high. Prove to me the risks are not in fact so, because what's going to end up happening is you're going to actually make no money and you're going to be sidelined, and then you're going to realize, oh my god, the market ran away from me, and at that point it's going to be too late. So your base case should be the other way around, where you're looking at the market like, okay, the market's automatically going to go up. It is. Over time, it's automatically going to go up. Now, there are certain periods of time, aka recessions, right, or drawdowns that come through fruition, and those periods have to be observed as they start happening and say, okay, this is why it's happening because of ABC. ABC are reasons not to be bullish. But once those ABC, whatever variables you have, expire, it's time to retire the bear case. The problem is, and we spoke about this adamantly in 2022. I remember us having podcasts late 2022, basically saying the lows in equities were in. Unless inflation accelerated materially from where we were then and growth fell materially from where we were then, the lows in equities were likely not going to be tested again. We had odds of chopping sideways, which we did actually here in the S&P for some time. We went up, we came back down. But long story short, the lows have yet to be revisited of 2022 because the bear cases expired into the end of 2022. The risk sentiment changed thereafter, but the main drivers of this market move down expired in
And
2022.
the bear case that I keep seeing all the time is that inflation is going to resurge. That's the main bear case that I'm seeing. And at the end of the day, is that even going to be bearish if inflation resurges and the Fed needs to hike a little bit more? I don't think that's even bearish enough to bring us into a recession. That's going to be strong growth.
Yeah,
If
I
they need to
think
keep hiking, the growth is going to be through the roof if we're even in that situation, which we're not. But
I
that's the bear case
think
that I see.
I think that if the Fed has to lift the target or lift the funds rate, that's going to be problematic, because I think that you're talking about a left curve event. But I agree with you. You're right. 100%. If inflation runs hotter than 2%, it's not the end of the world,
Yeah, and
right?
I mean it's not
Just
going to
because,
happen overnight either. Like the we would need to see inflation actually materially get higher before the Fed even starts thinking about hiking more. So it's not like
yes,
it's
I
going to
agree with
be
that.
a
Yeah.
left tail event that takes everyone by surprise. But even just going up into that scenario, I think even that's still bullish.
Yeah, because I would agree with you on that, because there's a lot of room here before the Fed actually has to raise interest rates. There's all they have this wide, they have over 200 basis points of real excuse me, it's a mouthful. They have 200 basis points of real policy yield implied on a forward basis, where inflation swaps are a year out from now versus where the Fed implied rate is a year out from now, meaning rate hikes, rate cuts, etc., what the market's pricing in a year from now, right? Where the Fed funds expected rate is versus the inflation rate that the market's pricing in. The Fed is positive by 200 basis points. We could take a country like the Eurozone, or an economy like the Eurozone, I should say, right? And they're in the high to low they're in the mid digits. Excuse me. They're in the sub 100 basis point mark range, meaning they're in the high 50 to 75 basis point range. So they are nowhere near as restrictive as we are in America. So I want to explain that again. The Fed has this broom where their level of restrictiveness can erode as inflation rises, with them still theoretically being restrictive. Now, this whole restrictive idea, the first literal answer that almost anyone will give you that is opposing my view of saying the Fed is restrictive will say, look at Bitcoin. This does not a sign of restrictive Fed policy. They'll say, oh, Bitcoin going up, the Fed's restrictive. That's absolute nonsense. Why is someone buying a speculative asset? And I don't want to get too much into the Bitcoin semantics, right? We can go back and forth. But long story short is asset prices are not indicative of Fed policy, right? Meaning, just because asset prices are at their all-time highs or close to them doesn't mean the Fed is therefore forced to not cut interest rates. They've literally done it in the past. The problem is the last time the Fed cut interest rates, everyone has this huge recency bias in the macro space. They look at, why did the Fed cut interest rates last time? Recession, right? Obviously COVID, right? Okay. Panic. Equities were down. That's why the Fed cut interest rates. Okay. Then they go back. Then they look at 2019. Why'd the Fed cut interest rates? They look at that and they say, no recession, nah, whatever. Doesn't matter. They write that off in 2019. Then they'll go to 2008. Why'd the Fed cut interest rates in 2008? Oh, GFC. Equities were down. Why'd they cut it in 2001? Dot-com bubble. Equities were down. So they completely, and that's where they stop. They don't go back to 1981 where the Fed was able to bring interest rates down and equities actually took a slight dip and went higher. There was no market crash. So they pay no attention to that. They pay no attention to 1989 where the Fed was dropping interest rates and the equity markets just went straight up, literally up only. Okay. No one cares about that. They have this heavy recency bias on things that just don't look at the whole picture. Now, why do I think the first question someone would ask was going to be this: do you really think the Fed looks at the S&P 500 and says, "Wow, the economy is not booming. Why should we not cut interest rates?" Well, the Fed has made it very clear that they're worried about maximum employment and price stability, right? And maximum employment they are at. Price stability they are getting to. They're not there yet, but we've made great progress. Inflation has come down quite a bit in terms of across the board. You can argue all you want. Disinflation is an active force in the markets. We can play the semantics of saying, like, oh, it's not really, it's PC super core. As we say always, super core is for the simps. Okay, it is nonsense. You look at super core when you are wrong and you want to make yourself feel right. Losers look at super core. You want to know why? Because it does not accurately predict the inflation landscape. You're taking all the most important things that matter in society out of that number, and you're isolating it to the most lagging factors in the economy and claiming inflation is extremely sticky. Number one, inflation is in fact sticky. It's not as sticky as everyone wants to make it out to be, and likely over time will continue to come down. I mean, we can take a look at where we were in February of 2023. We're now or March of 2023. We're now in March of 2024. Inflation was at 5% in March of 2023. 5% annual on an annual change basis. We're at 3.1 right now. To sit here and say inflation's made no progress, you are coping hard. You're coping hard to say that. And that's okay, because we need people to cope hard. Because that's what continues to fuel the equity markets higher, unfortunately. But long story short, inflation's making progress. Now, can inflation bounce? Absolutely. Is inflation going to go to 9%? I highly doubt that. I highly doubt. And that comes back to our analogy, our little chart here, right? Everyone says this is where we are in the inflation cycle, 1974. They're like, okay, the Fed just got inflation down. It's going back up. In reality, I have a feeling we're most likely post 1981. In my mind. And that doesn't mean, oh, that means equity markets are going to go up for this long and then crash.
Well, why do you say that?
Why do
Why
I
do you
say
completely take out the odds of another inflation wave?
so? What most people want to discount right away when they look at this inflation wave, right? Or I should say, what they want to immediately jump to is this idea that in 1980, 81, let's go back here. Let's see if we can throw this on the same scale so we can make it look right. So Over here, this second inflation wave the Fed cut way too quickly in 74. Way too quickly. And for those that don't know what I'm looking at, the orange line here is the Fed funds rate. The Fed cut way too quickly in 74. And they almost cut so fast that inflation had the ability, it didn't even bounce. Like if we look back, it barely bounced. It didn't even have the opportunity to bounce. And when it did, it just started trending higher and the Fed had to play catch up. The Fed went from extremely restrictive to extremely easy way too quickly, right? And that opened the doors for another inflation resurgence. Okay. We're not in the same position right now. If we take a look at inflation, right? The Fed's up here, inflation's down here, and they're contemplating about we're talking about 3 rate cuts. We were at 6 a couple of weeks ago. So we removed 3 rate cuts off the table for 2024 already. Mm-hmm. And the Fed's at 5 and a little over 5.25, and inflation's at 3% roughly,
Yeah,
right?
so basically they're in a spot where the longer they hold this, the lower the odds of an inflation resurgence, but the longer they hold this, the higher the odds of a hard landing.
Stage 4, exactly. This is the dilemma that I think the Fed is going to be playing, and has been playing and will continue to play, right? Because look, the Fed is restrictive. If you don't believe that they are, you're playing into the hands of the Fed. The Fed is I promise you, the Fed is sitting where they are right now. We have speakers coming out literally saying that they believe the Fed is restrictive. The only reason they're telling you they believe the Fed is restrictive is because they themselves are questioning if the Fed is restrictive. Don't think that they aren't. They are, though. They are restrictive. The problem
them
is
not realizing how restrictive they are
is the trade. That's the alpha. That is the alpha. Because what's going to happen is I wouldn't say the Fed's hiking interest rates anytime soon. Honestly, it's my opinion. That's a non-applicable risk at the moment. Maybe if inflation starts accelerating, I'll say, look, I was wrong. Doesn't make sense, and we'll see it. We won't be coming out after inflation's about the Fed funds rate. I think we'll have a better view on the dynamic well before that happens. But let's not even talk semantics right now. The Fed is going to sit up here, and every quarter or every month they sit up here, they're putting more and more risk on the economy. The forward policy rate will continue to stay highly positive and restrictive. And if the Fed doesn't come down, for whatever reason they decide to push off 3 cuts, and maybe it's an election reason, maybe they don't want to cut into the election, they don't want to look like they're being politically motivated to do anything, whatever it is, there's a lot of factors that can push the Fed over the edge. They should already be reducing interest rates, even if it's 1 cut every other month. Something. Just bring rates down slowly. Slow enough to where you can stop and pause and we can bring rates down 25 basis points, stop and pause, and it wouldn't do much damage. It wouldn't do anything. It really wouldn't loosen. It would loosen the restrictiveness maybe a little bit, but it wouldn't really accelerate anything, right? We have such a good spread on the tape right now. Like I don't think the Fed can start bringing rates down. That's here or there. We look at inflation swaps, right? 5-year at market expectation, inflation expectations. They are not only are they off. They ripped recently. Ripped is a hard word. They bounced a little recently. They're back down into the Friday's close. They're off 2023 highs. They're off 2022 highs, and they're hovering near 2023 lows. And for you to sit here and say inflation is resurging, it's noise. Let the market prove there's a reason to be afraid of inflation. The next thing will say, but bro, did you see crude rip on Friday? Crude's up 2%. This is not a rip, my friend. My brother in Christ, this is not a rip. Okay, you want to see a rip? This is a rip. When we go up like this, day after day after day, this is a rip in crude right here. This type of move. Crude's up 21%. And we've seen this type of action even prior to. We've seen rips like this happen, where crude just goes vertical, right? This is not a rip. We're not even above. If we go to January, we'll take the January high. We're not even 2% above January's high. Like, okay, crude's made some progress to the upside. And look, if it goes bullish trend, I'll be the first one to tell you, look, bullish trends tend to lead to higher prices. But not only do you have to go up, you now have to go up quite significantly, right? Because if we take a look at where crude's gone in the last year, it's up 2.87% in the last year. That's still under the current inflation rate of
And
3%.
it would need to go up quite a bit to really bring inflation back to being a problem. It's
Yeah.
not going to be a problem until CPI gets back above 5%, I would say.
Yeah, I don't. I mean, I would give it like 4 and 4 and a quarter, maybe. That people will start getting scared. But I don't see how you can be so pessimistic on the inflation progress when, we're literally banging on 52-week lows on the in inflation print wise. Like, are we there yet? No. But like, come on, it's not like if this black dot was like at 4%, I'd be like, all right, man, we got to worry. But like, don't worry until we start seeing some indication. The inflation's obviously not indicating that; it's still showing good signs of disinflation. Commodity markets are barely signaling that. Inflation swaps are certainly not signaling that. And then we have things like continuing claims slowly start to go up. These are signs that the Fed's policy is slowly starting to work. It's not going to happen all at once. A lot of people want to discount the fact that the Fed just went under one of the fastest hiking regimes that we've ever seen. To think that
It's
all those lags are just going to organically just it's the everyone's trying to treat this, and I want to bring this back to the idea of equities all-time highs. Everyone's trying to treat this as if the Fed's been restrictive for 5 years. Literally 4 years ago, almost to the day, we were about to unwind one of the most massive QE programs this world has ever seen. 4 years ago.
Yeah, and to think that that is already fully bled into the market and the rate hikes that they did just a year ago is already bled in, that's just foolish. It's
Yeah.
not bled in. It
Yeah.
takes time for these kind of things to play out.
And I think we're going to have to see like the Fed hold up. I mean, I think the Fed should be reducing interest rates ever so gradually. And listen, you don't want what ends up happening is you end up in a situation where the inflation starts shitting the bed real quick on you. And you're like, oh my God. And the Fed panics. And we don't want to be in that situation. But
That's the alpha situation.
that's the alpha situation where the Fed thinks right now that they are not restrictive enough. They're going to need to have to hold a lot longer than they really should, and they're going to fail to indicate at the checkpoints that they literally along the path where they should be dropping their pins and lowering the rate. They're going to refuse to, and and it's not going to be because stocks are at all-time highs. They'll cite something like employment's still at near record lows, growth is still positively above trend, or at least on a quarter-over-quarter basis, indicating above trend, or
But
at least at
what
trend
what
growth.
will be happening under the surface is the market is going to start picking up deflationary signals, and our system is going to pick up those deflationary signals and will likely flag deflation for us, where we will long bonds, and then we head into that environment where the Fed is forced to cut because they waited too long. And that is the bond trade that will be happening. That will be stage four. That'll be the bond trade. We don't know when that's going to happen. There's no timeline on that, but the system will pick it up when it is happening.